Now, those don't lower your taxable income, but it's a nice benefit because it's like free money, right? So if Hi, I'm Bette Hochberger, CPA, CGMA. This channel covers tax strategies and preparation, real estate finance, and more. Come learn how to grow your business and keep your wealth. Today, we're going to talk about, does a 401k reduce my taxable income? Yes, it does. And here is how. Okay, so mechanically, what is a 401k? 401ks are a specific type of retirement account. There are other retirement accounts out there. There's like, the IRA, a SEP IRA, a simple IRA. 401k is the one you are most likely going to run into if you've got a day job. You can also, as a business owner, set up what we call a solo 401k. So if you were self-employed, you can also reap the benefits of 401ks as well. So that's what it is. Now, how does this work? How does it reduce your taxes and your income? Well, a traditional 401k is what we call a pre-tax contribution. So, for example, if you make $10,000 on your paycheck and you put $1,000 into the 401k, it's going to show up that your taxable income is only $9,000, right? It literally takes it off the top. So it reduces your income in general. It reduces your taxable income. And that money that you're contributing goes to future you. So unlike when you just pay taxes, that kind of stuff, or like insurance, yeah, that can be pre-tax as well, but it's not like it's yours later. Like, you're getting a benefit, but this is literally setting money aside for future you to use in the future. So that's how it works. Now, how much can you put in? Can I put my entire paycheck in? We wish we could take all of our money, set it aside, not pay any taxes on it now, and only deal with it in the future. But for 2025, the contribution is $23,500 for the year if you're under 50. If you're over, there's what they call a catch-up contribution because you're getting closer to that retirement age and you want to be able to sock more money away maybe if you weren't doing this in your younger years. So there is a catch-up provision when you're over 50 of $7,500 for the year, and that would bring you to $31,000 for the year if you're over 50, right? And this is the employee side. The employer, the company you work for, and if you're working for yourself, you're kind of both sides of it, right? So you can kind of maximize that and put both sides in. They're also able to make contributions on your behalf. Now, those don't lower your taxable income, but it's a nice benefit because it's like free money, right? So if you have a match, like sometimes it can be easy, like, oh, we'll match, 2.5% or something like that. Sometimes it's complicated. I've seen them where it's like a whole graduated scale, like we'll do 1% of the first X amount and, things like that. You can make these things hard and complicated if you want. If, when they're kind of a little bit simpler, it's easier to do the math and figure out what the benefit is. But basically, if you're able to get a match from your employer, it's like free money. There ain't no free lunch. Once you go start taking the funds out of the 401k many years in the future, well, now that income is going to be taxed. So the thought here is that when I'm in my earning years, when I'm working and getting paid, my income is high. I'm making a lot of money. My taxes are also high because it kind of scales, up. The taxes go up with the income. When you retire and you're not working and you're just living off of retirement accounts that you put money into all along, your income is going to be lower because that's all you're earning and it's all the taxable income is what's coming out. So those distributions are taxable down the line, in theory, at a lower rate. Now, I do want to talk about one other thing. We have this other type of 401k, which you might see as an option, which is a Roth 401k. So these are special because they come out after taxes. This is like, I made $10,000 and I got taxed on $10,000 and here's whatever my net check is. Now from that net amount, I'm going to put money into that Roth. That's what it means, that it's like an after-tax contribution. But why are these nice? Well, when you go and take these out down the line, when you're old and retired, these are tax-free. So it's like, you got to balance. You kind of have to figure out, is it better for me to pay the tax now maybe I'm in a low tax bracket. I'd rather take those after-tax contributions, let it grow over time. You got to do a little bit of math, right? And this is where it's great to have financial advisors, tax advisors, all these folks that can help you kind of figure out what those various decisions look like and try to model it out for you for your future. So that's kind of in a nutshell 401ks. Yes, available to you even when you're self-employed. If you're looking to set up a 401k or some kind of retirement account, get in touch with us. We work with a lot of partners that set these accounts up, tax savings. People are generally happy. Clients that we do this with are happy because it's win-win. You're saving dollars now and you're saving dollars later, right? So who doesn't like to save money? Don't pay taxes when you don't have to. So that's it on 401ks. Hope you found that useful, and we'll see you next time. Thank you for watching. If you found this helpful, please leave a comment, like, and subscribe. Stay tuned for more tips on growing your business and your wealth. Bye.